Hey, Jeff, good morning.
Andrew, how are you?
Good, good. So we're just a couple of days before the Bank of Canada rate announcement on Wednesday, December the 11th. And if you're like me and like anyone else that sort of works in the real estate world and follows the Canadian economy and what's going on, we're all watching to see what happens with the Bank of Canada's rate decision this coming Wednesday. There's obviously discussion due to the unemployment figures that were released last week. Canadian unemployment shooting up to 6.8%. I believe it's the highest in 7 years, with the exception of the pandemic. Canadian Bank of Canada is thinking maybe another jumbo rate cut, 50 points. Many pundits, economists are thinking that's the way it's going to go. The percentage increase of that happening, probability has increased, I think, to about 67%, according to what I've been reading this morning.
Good.
And then there's a camp that's thinking maybe just a 25-point cut. And that was kind of the consensus before the unemployment rate figures were released last week. And then I think there's a small segment of individuals that maybe think there's going to be no rate cut. Jeff, what is your feeling on what the Bank of Canada is coming to do? We're all waiting and listening to see what you're going to say.
So when we were at dinner on Saturday night, we were discussing this. I said, I think because of the potential for currency impact, maybe there's going to be no change. And so I did a little bit of a deep dive yesterday, and I'm going to retrace my steps, but I'm actually going to take that position for this announcement from you and I.
Okay.
So,
Well, I had a feeling if you did a bit of homework over the weekend, you might have sort of rethought what you were thinking. Because were you not in the camp? You were thinking there was going to be no rate cut. You thought they were going to hold firm with just keeping things status quo.
I did. My primary thinking for that was because of the impact it would have on the Canadian dollar. I know they're not connected, but I don't think you can totally disengage the political from the economic. And on the heels of a recent meeting where it was, say, floated that Canada would become the 51st state, I think that there might be some, how can I say politely, pressure to keep the Canadian dollar a little bit stronger. So I'm going to take the position for no change to the overnight rate. And here's why.
You better have a strong argument because
Yeah,
you make
listen,
about
I think
you make up about 2% of the pundits out there. But go ahead. Let's hear what Jeff Bennett has to say.
so on the pro side, no change would help maintain some economic stability.
Yeah.
So keeps borrowing costs predictable, reduces potential market volatility, helps anchor some of those inflation expectations if inflation remains above target. That's number one. Number two, supports some currency stability, which was my argument at dinner. A steady rate could prevent significant depreciation of the Canadian dollar, maintaining purchasing power for imports and containing import-driven inflation. Number three, international alignment with some of the other major central banks, like the Federal Reserve, which may also maintain interest rates, and avoids potential capital outflows to countries offering higher interest rates. David, our friend, he used to say, a 1 or a 2% interest rate differential can suck money off Mars. And so I think that's something else that needs to be considered. And the last one of the points for me is it's going to prevent some overheating in the housing market. As we know, interest rates don't directly, but they certainly are adjacent to some of the sentiment in the housing market. So if lower rates have contributed to rising housing prices, maintaining the rate may help curb some speculative activity.
Okay. So yes, it sounds really impressive. Whether it's going to hold anything behind it, all the best to you, Jeff, because I think, as I said, the majority are feeling, some are in the 25 camp, many are in the 50. I'm actually in the 50 camp. So we're taking opposite ends of the spectrum here.
Yes.
I think that, again,
And Andrew, I think
yeah.
that's healthy for our relationship.
Oh, yeah, it is. Once in a while we do disagree. And this is one of those where, I think we're definitely at opposite ends of the spectrum. But again, listening to what I hear out there, yes, the Canadian dollar is definitely taking a battering. There's no question. I think that it's already factored in. I think they're almost expecting the markets that there's going to be at least 25, possibly a 50-point cut. The current rate of the dollar, about 70.7 cents US right now, is already, a lot of that's already factored in. But there's no question, if we see a 50-point cut, I think the dollar is going to get another hit. There's no question. The Canadian economy, from what I hear, is flat on its back. Unemployment is at a 7-year high. Job creation is stagnant. Most of the jobs created in Canada over the last many years, I think it's like 8 or 9 years, 50% have gone into the public sector. That's the government. So government jobs, not private sector jobs. Housing starts have fallen off a cliff. New development. So that's development where people have bought development projects in the last 6 to 12 months, fallen off a cliff. So all those cranes that you see up right now, all that development around the city, it's quite a bit of it. All those projects got started years ago. So sort of in the ballpark of 5 to 10 years ago, but new development in the pipeline has almost dried up. Housing starts way down in Vancouver and in the GTA, the Greater Toronto Area, which are the two big barometers for Canada. The pre-sale market is flat on its back. And I think that the Bank of Canada needs to stimulate the Canadian economy to get the consumer, which is also very highly leveraged. We've got all these rates coming that are going to get readjusted in 2025, 2026. Consumers and businesses are highly leveraged. We need to save the Canadian economy. And I think the Bank of Canada is going to come forward with a rate cut to sort of try stimulate and get people feeling a bit more positive. Because that's kind of more of an immediate thing. Even though a 50-point cut isn't going to make people feel wealthier overnight, it's going to give them some hope going forward that things are going to get a bit easier. And for real estate, as you know, the last 2 months, you've seen a nice bounce back in activity, but we're still well below, the 10-year averages. I think Toronto is still 25% below. We've bumped up to close to 10-year averages, but I still think the overall market in Vancouver remains very soft and uncertain as we go into 2025. So for all that reason, Jeff, before I start slurring on my words, I think it's a 50-point cut.
Excellent. And I'm happy to be wrong about no change.
Hey, and one thing, we're not economists. We're
Yes.
not tax planners. We're not investment advisors. So if you're thinking of making a large or a real estate purchase, always consult with a true professional with respect to taxation and your financial situation.
Yes. Insert standard disclaimer here.
There you go. Hey, Jeff, I guess we'll talk on the other side of the rate cut, and then we can bash each other up then, and depending on who was right and who was wrong.
I think you'll be mocking me. And I'm fully prepared for that. I think it's also important to have both sides of the argument here.
Hey,
So
yeah, absolutely.
maybe we'll both be wrong and it'll be 25 basis points.
Well, so meet in the middle, right? Meet in the middle. Hey, listen, all the best to everyone that's listening in. Have a great day, and we'll talk to you soon on the other side of the rate cut.
Awesome. Thanks, Andrew. We'll talk
Okay.
to you Wednesday afternoon.
So sounds good.